I got to tell you something. We went from initially like, Jay Powell may have put a wrench in this thing to like, maybe he didn't. Market's looking much better. I want to bring in now Kobeissi, letter editor-in-chief, Adam Kobeissi. Adam, just what do you make of this action right here? Was it just because it wasn't as bad as it could have been?
Yeah, I think the Fed just really wants to take this wait-and-see approach, meeting by meeting. They've been saying this forever now. And now we're at that point where we could really be at the highest Fed funds rates. We're going to see that 5.25 to 5%. And I think the Fed's getting ready for a long pause. I think rate hikes are probably done. Could we see one more if inflation data gets bad? Right. Yes. But it looks like we're bracing for a very long pause with a higher for longer Fed funds rate.
But do you find that interesting? Like, for instance, when they started hiking initially, remember tech stocks got hammered and everyone would come on TV and say, well, when interest rates go up, the tech stocks go down. All of a sudden, tech stocks had the best first half ever. So at higher rates, I mean, are the rules being rewritten?
I think this market is just so resilient, and people know that the dips just continue to be bought. So every time that we see even a 5% pullback in any of these big tech names, you see the dip buyers step back in. And now 5% has become nothing. I mean, NVIDIA, after earnings, was swinging 10% like up and down like it was nothing. So I just think the market is very resilient. People are less worried about what the Fed is going to do rather than maybe we're going to have a soft landing or somewhat of a soft landing. And inflation is starting to approach 3%, potentially 2% into next year. Into the end of next year. And look, I think the Fed's going to take it meeting by meeting, and that means that there's no real reason to panic about a severe recession right now.
So inflation's coming down nice and slow at a moderate pace, no recession. I want to point out one thing. You've been bullish all year on stocks. You've been right on that. You were bullish on bonds, TLT. You've given up the ghost. In fact, you've gone to the other side. Now you're bearish.
Yep. I mean, that's been one of our iffy trades, but we're now bearish because we just think this long pause is coming. If you look at the futures on the Fed funds rate, now we're seeing cuts starting in June of next year, June 24. At one point, there were 3 cuts priced in this year.
Yeah.
So I think we're just preparing for a very long pause. And the Fed made it clear today, they made it clear for the last 3 months, they're not budging until we get to 2% inflation. So they don't want to move early. They don't want to risk inflation rising back to 4 or 5% like we saw happen in the 80s after the 1970s wave of inflation. And I think Treasury yields are going to keep rising. 10-year could go to 4.5% easily.
Wow. I got to tell you, right now, all of this smart money is loading up on bonds. I think it's a mistake, too. 30 seconds, less than 30 seconds. On the downside, your key support number is around, what, 43, 4,200?
Yeah, so 43.90 was that higher low from July 10th in the S&P. So actually, that uptrend was technically invalidated. But we don't really think that this is the start of a major crash. I mean, dips are already being bought. As you saw today, we were down, now we're up. We could see 4,300, we could see 4,200, but ultimately, I mean, we're buying in the medium term, and I think that this is going to be a great dip buying opportunity once all the Fed noise kind of settles into November.
All right, Adam, great stuff. You've been rocking, my man.
Thank
Have
you.
a great week.